Right, good. So let's carry on. Question 11 to 15. So this is about the conceptual framework. This is very much knowledge. So conceptual framework, there's two things: relevance and faithful representation. And these are very much relevance is very much again about whether or not it should be, almost about recognition, almost whether or not it should be there. So very much about the asset, whether the asset should be there in the first place. Very much about the cash flows coming in. We actually want to, will the user, does the user need to see this thing? Should it be there to make sure it's, if you like, it's um if you like, if it will happen, almost if it's going to happen. I almost like to think of this as an event, the event of the asset or the event of the cash flows. And faithful representation, of course, is really, like you say, a representation of this thing that's actually going to be there, or those cash flows. And you almost have issues of judgment, if you like. And it does feel, what I think the question is, that what the old standards, again, this is all knowledge, did was to kind of, the recent framework, or the conceptual framework, kind of took away the word prudence from the picture, because we've had prudence for such a long time, and in a way there has been some kind of understatement, so to speak, with prudence. And the argument was that it wasn't as effective a word, again, I guess is one way of putting it. So the what is considered to be a characteristic of faithful representation is the fact that everything is there, and so neutrality has become taken really the place of prudence. There are arguments in, if you like, in the current the amendments and the exposure draft to bring prudence back. But really, the three that we're interested in here are these three. So this is a knowledge thing, and hopefully, as you do this now, you remember it. But you can please read the chapter again on the conceptual framework. I might even have a video on it, but we can highlight, we can focus on that. It's more a reading chapter. Again, principle based, you can kind of go back to what you remember, just going back to what you think. If you compare the idea of principle based versus a rule based, which is prescriptive, rule based or prescriptive, this is really kind of saying, following this question of um, the spirit, following the spirit of the law, as opposed to what's actually been written. So when I say following the spirit of the law, we can almost think of it again, as, if you like, the substance over form. So what am I saying? So if you're following a principle-based approach, then you're more likely to kind of react sensibly. So it says it avoids firefighting where standards are developed and so as problems arise, because you're following the principles, so to speak, you are thinking along those lines. So you're better able to deal with specific problems as they arise. So this is correct. It allows you to deal with complex transactions which may not be completely covered by an accounting standards. And this is also very much um, correct. Principle-based standards are thought to be harder to segment, but yeah, because it's based on the spirit of it. Um, every rational man would argue, well, yes, this is how it should be. You're less likely, if it's lawful, or you can say, well, if it's rules based, then it's easier to kind of circumvent. It's not a set of rules. It's not a set of rules. And accounting standards can be developed in relation to agreed principles. So it's very much, again, like I say, following principles. And so the answer here is D. So what do we have here? You have a head office. So this is very much on our statement of financial position. We will depreciate it, even though we revalue it, and because, of course, it is not income. So the framework says, well, it isn't income. So recognizing it on your statement of profit or loss, recognizing the revaluation on your profit or loss, is not a faithful representation of income. It's just this change in fair value. So you can recognize it in other comprehensive income, in effect, or if you like, as a revaluation surplus. So um, we what we have in effect is this thing here, where we have this thing's been revalued to 21 million, and we have a revaluation surplus or revaluation reserve, if you like, of 7 million, and it tells us we have 35 years remaining on the life. Then it tells us that the key point here is, I prefer if they put this here, but it's good to pick it up. Nest makes annual reserve transfers from excess depreciation. So we can, if you remember, transfer some of the money from here, some of the reserve from here into to offset the depreciation charge. There we go. So yearly, I would go right 21 over 35. I would find out what the yearly depreciation is, and whatever it was, I'd put it here, right? So credit or accumulated depreciation. Either you go accumulated depreciation, either credit accumulated depreciation. I'm doing exactly the same thing here. Here's the asset, same thing. These are the same things, but the theory. Let's say I'm not going to do this one. I'll create an accumulated depreciation, credit accumulation, debit depreciation. What I can also do at the same time is literally do that, right? So just take a bit of here and bring it here. How do I know what to do? Well, I have the same principle. I have 7 million here over 35 years. I'll gradually release that. So 7 over 35 is what I will release from here every single year. So now I've done January X5, so that's December X5, December X6, December X7, December X8. So that's 4 years. So I would have transferred 4 years of revaluation out of here over the 4 year period. So that would have been, so that would leave me technically with 31 years left, right, of revaluation available in the revaluation reserve. So 31 over 35 times 7 million is takes me to 6.2 million. So in effect, I have this revaluation reserve now. I mean, this is recorded, so you can easily kind of do this, follow what I'm doing again. In effect, I have this revaluation of 6.2. I have this revaluation of 6.2 million sitting there now over time. Then it says now that property prices have crashed to 11 million. So let me just very quickly work that out. So I had here 21 million. So over time, I have done 4 over 35 times 21. That's what this is, 4 divided by 35 times 21. That's 2.4. So over the 4 years, I have accumulated depreciation of 2.4 million, and that's gone out. So technically, my carrying value just before the crash would have been 2.4 minus 21, which is 18.6. So I'd have had here 18.6 in effect. I'm just going to get rid of this and just do this. So I have here 18.6. So I have 18.6 and I have 6.2 here. So it says here that this thing crashes to 11 million. So in effect, if this crashes to 11 million, so here, so if I bring this down to 11 million, that is, where are we? 18.6 coming all the way down, 18.6 minus 11 is 7.6. So when I bring this down to 7, take 7.6 out of there to my income statement. So I have 7.6, and I now transfer, well, because I'm having this loss of 7.6 here, I can now transfer all of this to offset some of that. So debit revaluation reserve, credit income statement, which will leave me, if you like, a balance here of 1.4 million. Yes. So really, it's really a case of using the revaluation reserve as you should. I mean, it has fallen in value, and it does make sense that that revaluation can now be offset against that. Okay, great, and that's that. So number 14, this is consideration. We talked about this again, this question of consideration. You can have consideration in cash, you can have consideration in shares, you can have consideration in deferred cash, which is what this question is really doing. So what we have to do is to manage that situation. So what's the first level? It says you have a transfer of 500,000 shares and the market value. So you have paid for this investment. What is your consideration? 500,000 shares at £3.50 each. So 500,000 times £3.50. That takes us to 1.75 mil. That's the first one. Then you also pay 408,000. So that's 0.408 as well, million. And then it says that you have agreed to pay £1 million in, so where are we? 1st of Jan. So that is December X1, December X2. So in 2 years' time, you'll be paying this amount of money. So in effect, what is the present value of this? The present value of this, of course, right, must be 1 million divided by 1.09 squared, right? So 1 divided by 1.0, well, I just do 1.09. 1 divided by 1.09 divided by 1.09 again gives me 0.84. I'll just round it up to 0.842. So when I add all these three together, 1.75 million plus 0.408 plus 0.842, you will get the 1.75 plus 0.408 plus 0.842, you will get 3 million. So you have 3 million there. So that's the first thing. So this business of legal and professional fees, because the standard on recognizing consideration does not allow for the capitalization of legal and professional fees. For financial instruments that you intend on holding for the long term, it does, but you'll see that later on as you go along. So generally the rule is that, I mean, personally, I could argue, I mean, I could see how someone could argue, well, we could, this technically could pay this, and in effect it is part of your consideration, and in fact we see it spill out as part of goodwill in effect. But I mean, it is an expense, of course. It is an expense, but that's what it is. And credit bank, so you're paying for it straight away, but it's not capitalized according to the standard. Even though this is an investment really somewhat in the long term, you could argue. So it isn't C, because C would have, if you had added that, you would have C, but it really is B. And that's what's really going on there. How long? Okay, great. And then finally, um, the standard on agriculture, IAS 40, I believe it is. I will have to check. I always mix this up with in this one with investment properties. I think this is actually agriculture. I'll check. But this is always at fair value, just because it's so subjective. Always at fair value. Always work it out at fair value. So what we argue here is you have Sacco. They own a 1-year herd at the 1st of January. Always at fair value, less whatever cost to sell. Fair value of a 1-year herd. 1-year herd is 70,000. At the 31st of December, the fair value of a 1-year herd is 75,000. So by the end of the year, 31st of December, your herd will be 2 years old. And in effect, it's saying to us that, so in effect, you have this herd currently at 70,000, so that's your asset. And in effect, it's saying that what you have to do is that we want to revalue this. The question is, how do we revalue this? To what? It says if Sacco sold the cattle, commission will be 5% payable. So technically, because because your herd is now 2 years old, so 5% of that, 0.05 times 80,000 is 4,000. So technically, you would have to pay commission expense of 4,000, because 5% of 80,000 is equal to 4,000. And so you have 4,000 there, and so you have, well, again, like I say, you are revaluing this, and it's going straight to the income statement. So we recognize all our profits and losses straight away. So it's now worth 80,000. So technically, that's 10,000 going to my income statement of 10,000, if you like, and that's the expense of 4,000 coming off that asset. So in effect, you have 80,000 minus 4, which is revalued to 76,000. We go straight to the profit or loss. Everything, there is no holding on in the revaluation, any revaluation of surplus or anything along those lines. It's just all profit is recognized straight away for the standard, taking us into B. So great. That brings us to this question 11 to 15.